As we head into the weekend, with the markets now closed, let's look at where Nuburu, traded under the ticker BURU, ended the week. On Friday, November 7th, 2025, Nuburu stock closed the session at $0.2804 per share. This was a notable move, finishing the day up $0.0096, which translates to a gain of 3.55%. What makes this finish particularly interesting isn't just the percentage gain, but the activity behind it. The stock traded on massive volume, with nearly 56 million shares changing hands. This is a huge figure for a stock at this price level, indicating a significant amount of attention and conviction from traders. It wasn't a quiet drift up. The day was volatile, with the stock opening at 0.26, dipping as low as 0.2435 before hitting its high right at the closing bell. This end-of-day surge suggests a scramble for position, but the question is, a position in what? The immediate and perhaps most critical insight that most people are missing is that Nuburu is not the company it was 12 months ago. If you're looking at this stock and thinking it's just a struggling industrial laser manufacturer, you are looking in the rear-view mirror. The expectation is that this is a failed post-SPAC entity, another piece of speculative tech that didn't pan out. But the reality, the story that 56 million shares of volume is trying to tell you, is that this is a company in the middle of an aggressive, high-stakes, and radical pivot. This isn't a story about lasers anymore. This is a story about a strategic and deliberate attempt to build a defense and security technology platform. The company is actively acquiring and aligning assets to go after the defense, drone, and military software market. This isn't a tweak to the business model, it's a complete corporate overhaul. Let's establish the common ground, the expectation that most of the market holds. When you pull up BURU on your Robinhood app or SoFi Invest platform, you see a stock trading for pennies. You see a 52-week range that stretches from a painful 0.12 to just under $1. You might run a quick screen, look at the financials, and see a net income loss in the tens of millions against trivial revenue. Your immediate conclusion, quite rationally, would be to dismiss it as a micro-cap gamble, a name to avoid while you focus on your Fidelity mutual funds or stable blue chips like Apple stock. The average person practicing online investing would see this as a warning sign, a stock that has failed to find its footing. They'd perhaps be better off with Schwab Intelligent Portfolios for a more managed approach. But this expectation, while founded on historical data, is now obsolete. The reality is that the stock's recent behavior has nothing to do with its legacy blue laser business. The narrative has completely changed. Let's look at the recent trading. That 56 million share volume on Friday wasn't an anomaly. Go back to early October. On October 7th and 8th, this stock saw trading volume that exceeded 1 billion shares in a single day. Let me repeat that, over 1 billion shares. This is not the behavior of a forgotten, dying company. That is the footprint of a massive repricing event, a violent disagreement in the market about what this company is actually worth. This is the kind of activity you see when a stock is undergoing a fundamental change in its very DNA. What we are witnessing is a high-risk bet. The people buying at these levels aren't betting on the existing blue laser technology. They're betting on the transformation plan that the company's management, led by its executive chairman, has been broadcasting to the market. So, what is this new company? In just the last few weeks, Nuburu has been incredibly active. On November 6th, it put out a press release stating it was strengthening its balance sheet specifically to advance its defense tech acquisition program. This isn't just talk. At the end of October, Nuburu announced it had completed the first phase of its acquisition of Orbit, a company specializing in software-driven operational resilience solutions. Think defense-grade SaaS. This move is intended to plant Nuburu squarely in a multi-billion-dollar defense software market. But it doesn't stop there. Nuburu has also announced a strategic alliance with Maddox Defense to form a controlling interest joint venture. Their goal? to build and deploy military and commercial drone systems. So in a matter of months, Nuburu has gone from laser company to laser company plus defense SaaS plus military drone maker. This is an entirely different investment. This context is crucial. The volatility you see is the market trying to digest this transformation. This is no longer a simple industrial play. This is a complex buy and build strategy. The risk profile here is extreme, and it's not for everyone. This is not a stock for someone looking for stable, long-term investment help or a simple, intelligent portfolio. This is a highly speculative, active trader stock, the kind that platforms like Interactive Brokers are built to handle. The potential outcomes are wildly divergent. The massive trading volume spikes in October were likely a combination of short covering and a new set of speculators taking a large position, betting that this transformation will succeed. The institutional ownership figures tell a similar story. It's incredibly low. Less than 2% of the company is held by institutions. The big names, the Fidelity Wealth Management divisions, aren't here. The largest holders are Vanguard's extended market funds, which have to own it as part of their index, and a few other small firms. This is, for all intents and purposes, a retail and speculator-driven stock right now. To be fair, let's briefly touch on what Nuburu was, because the original technology is the one asset they bring to this new fight. The company was a pioneer in blue laser technology. This isn't just a different color. Blue lasers have a specific physical property. Their wavelength is more efficiently absorbed by metals like copper and aluminum than traditional infrared lasers, making them far superior for welding. Why does that matter? Think about EV battery manufacturing. You have to weld hundreds of thin copper and aluminum foils together. Blue lasers can do this faster, with fewer defects, and with less spatter. This was the original story, and it was a good one, targeting key markets in e-mobility, electronics, and 3D printing. The problem, as the stock price suggests, was turning that technological advantage into a profitable, large-scale business. The revenue just never materialized in a significant way. And so we return to the future outlook, where the tension between expectation and reality is at its peak. The market's base expectation is that this is a penny stock that will, like most penny stocks, trend toward zero. The charts support this fear. The company has a history of unprofitability. It recently had to regain compliance with the NYSE American Exchange. The risks are enormous. The primary risk is execution. A buy and build strategy is incredibly difficult to pull off. Integrating different companies, technologies, and cultures is a massive challenge. Doing it in the defense sector, an industry notorious for its long sales cycles and complex relationships, is even harder. There's also the cash burn. This transformation costs a great deal, and the company is financing it through equity, as seen with a $12 million public offering in September. This means dilution for existing shareholders. But then there is the other side, the new reality the bulls are betting on. What if they succeed? What if the Orbit acquisition gives them a foothold in a high-margin software business? What if the Maddox Drone JV actually wins a contract? They're targeting NATO and allied customers. If they can secure even one or two significant contracts, the entire financial profile of the company changes overnight. In this scenario, the legacy blue laser business becomes a small, supporting R&D division for a much larger, diversified defense tech corporation. The upside in this case is dramatic. A company with real defense contracts and SaaS revenue would not be trading with a market cap of under $40 million. This is the binary bet that traders are making. This isn't like analyzing Tesla stock, where we argue over delivery numbers and margins. This is a question of corporate survival and reinvention. This is what makes this stock so fascinating at this moment. The disconnect between its past and its potential future is a chasm. The expectation is a failed tech company. The reality is a high-risk, high-reward attempt to build a new defense platform from scratch. The company is pivoting from industrial welding, a market with competitors, to military drones and software. Given this dramatic shift, it's worth asking what the market thinks. Look at this pivot. They are moving from industrial lasers to military drones and software. Comment below, is this a brilliant strategic move or a desperate Hail Mary pass? In summary, the story of Nuburu closing at $0.28 is not about a 3.5% gain on a Friday. It's about the market trying to price a company that is fundamentally changing its identity. The expectation is that you're looking at a sub-$1 stock, a poster child for self-investing gone wrong. But the reality is that you are looking at a management team pushing all its chips in on a completely new strategy. The game is no longer, can we sell more lasers? The game is, can we acquire and integrate our way into the defense industry? The risks are profound. The cash burn, the integration of new businesses, the intense competition, and the history of unprofitability all paint a